Hi class, we're on chapter 6 now, which covers corporate liquidating distributions. Now in our last chapter, chapter 4, we talked about non-liquidating distributions. In this case, we have a company that's is going to distribute all of its assets and liabilities and pay off all of its liabilities. So it's essentially going to liquidate. And then it may actually shut down after it liquidates. It may dissolve as a corporate entity. Now, this situation arises when the management decides that they no longer want to operate the corporation for a number of reasons. And there are two ways that you can shut down a corporation. You can sell all of the assets first and pay tax on the gain, and then distribute the cash that you received on sale of the assets and any remaining cash that you had outside of the sale to your shareholders. In that case, the corporation is paying tax on the gain on sale of its assets, and then the shareholders are paying tax on the distribution as well, because it's either going to be treated as a dividend to the extent of E&P, of corporate E&P, or it's going to be treated as a return of basis. And then because the corporation is liquidating, the basis is always going to get reduced down to zero, and whatever's distributed to the shareholders in excess of basis is going to be treated as capital gain. So you can see in the first situation that the situation of selling the assets first and then distributing the leftover cash creates double taxation. The other way that you can shut down a corporation is by distributing the corporate assets to the shareholders. And in this case, you're still going to have 2 layers of tax on the gain, as we'll see later. Now, in the book, there's a nice example that's laid out for you on page 3, and it's actually pictorially shown here. And in this situation, we've got Randy Jones, who owns Able Corporation. Here's Randy, an owner. We also have some creditors, people who Able Corporation owes money to. We've got an unrelated purchaser of some of the assets of Able Corporation. And then we've got the government shown down below, who is going to be the receiver of taxes owed on the liquidation of the corporation. And in this situation, Randy is 100% owner of Able Corporation, which is a C corporation, and Randy's basis in the stock is $100,000. The corporation's assets they have $50,000 in cash. They've got stock with a basis of stock in another company of $75,000 basis with $125,000 fair market value. They've got machinery with a basis of $115,000 and a fair market value of $200,000. And in step 1, Able sells its machinery to an unrelated purchaser for $200,000, which is the fair market value of the machinery. And since the machinery had a basis of $115,000, there's an $85,000 gain on sale of that machinery to the unrelated party. And then you have to determine the character of the gain. Well, the machinery actually originally cost $250,000, but they claimed $135,000 of depreciation on the machinery. So remember from your past chapter that then that's going to be a 1231 asset, and to determine the character of the gain of the 1231 gain, since this is a 1245 asset, a section 1245 asset, to the extent of depreciation, the lesser of the gain or the accumulated depreciation is going to change the character of the 1231 gain from capital to ordinary. So the smaller of the accumulated depreciation of 135 and the gain of 85 is 85. So the entire $85,000 gain is going to be ordinary in character. And then they're going to pay tax on that. Then in step 2, they use $60,000 in cash that they received from the sale of the machinery to pay their creditors. And then, because they owed their creditors $60,000. And so that leaves them with $200,000 in cash that they got from the outside party minus $60,000. So that leaves them with $140,000. Then in step 3, they distribute the remaining cash and the stock, which is a capital asset in the hands of the corp, to Randy. And Abel recognizes a $50,000 capital gain on that distribution. And that's equal to the fair market value of the stock, which is $125, minus the basis of $75. So that's a $50,000 capital gain. Assuming a 34% tax rate that Abel has on its taxable income, it's going to pay $45,900 in taxes, which is the $85,000 ordinary gain from sale of machinery plus the $50,000 capital gain from sale of stock times 34%. They're going to pay that to the IRS, which is shown down here. And then in the next step, in step 4, this tax payment reduces Abel's remaining cash to $144,100, which is $50,000 plus $200,000 sales proceeds minus $60,000 paid to creditors. Remember, they already had $50,000 in the bank. Minus $45,900 paid in federal income taxes. So the remaining cash is the sum of all that, $144,100. And then they distribute that remaining cash to Randy. Randy recognizes $169,100 gain on that sale, on that distribution, which is deemed to be the sum of the $144,100 in cash that's distributed to him, plus the $125,000 fair market value of the securities, minus his $100,000 basis. So to the extent of basis, there's not going to be any E&P left after they've distributed everything. So E&P is 0, or it's probably even a deficit, which is why this corp's going out of business. So the next layer then in a distribution that you look at is the basis of the distributee shareholder, and he had a $100,000 basis in Abel Corporation. So first his distribution reduces his basis down to 0, and then whatever's left over, which is $169,100, is deemed to be long-term capital gain. So what they say in the illustration in the text is that the same federal income taxes would have occurred had Abel sold both the stock and machinery to unrelated purchasers, or had they distributed both the stock and machinery to Randy because of Abel's non-cash assets having fair market values exceeding their adjusted bases. So if you follow what I just said to you by looking at the illustration on page 3, it'll make a lot more sense to you, and I would do that because it's a really nice illustration of what happens, how a C corporation gets double taxed on distributions, and how a liquidating distribution works in the scheme of things. If you think about how it gets rid of all of its cash and how it relieves itself of all of its liabilities when it liquidates. Okay, so now that we've been through that illustration, let's talk about the rules. So when a corporation distributes assets to shareholders, the liquidating corporation is taxed as though it sold its assets, as we saw in the illustration. And then shareholders are treated as if they sold their stock. There is an exception to that, and that's where a controlled subsidiary is liquidating into a parent, meaning that the subsidiary is owned 80% or more by its parent company. And when that happens, when the subsidiary liquidates into the parent, in other words, all of its assets are distributed up to the parent, then the parent recognizes no gain or loss, and they carry over the basis and holding periods of the received property from the subsidiary. And this makes sense actually, because all in all, on a consolidated basis, if you look at the wholly owned or the controlled subsidiary and its parent, nothing economically has changed via the transfer of assets from one entity to the other. It's kind of like taking change out of your left pocket and putting it into your right pocket. You as a person still own all of that change. It's just changed hands, or in this case, changed pockets. So that's why there's no gain or loss, and that's covered under section 332. There's a really nice table, by the way, on page 5. It's table 6-1, tax consequences of a liquidation to the shareholders. And it talks about the general rule that I just discussed, and then it talks about the controlled subsidiary corporation rule under 332, and what the character of the gain or loss would be if there is one, what the adjusted basis of the property received is, and in the case of distribution that's not, liquidation that's not covered under 332, the adjusted basis of the property received is the fair market value of the property, and the character of the gain or loss recognized is actually capital gain or loss, because the shareholder is treated as selling, having sold his stock in receipt of the property, in exchange for the property. And then the holding period begins on the day after the liquidation date if it's treated as a sale and not covered as a non-taxable event under 332. So take a look at that table on page 5 because it's very helpful. So as I just discussed when I walked you through that table on page 5, there are issues that we have to look at, just like we had to look at the same issues with regard to non-liquidating distributions. We have to now look at the same issues for the shareholder in the case of a liquidating distribution. And that is, what is the gain or loss realized? What portion of the realized gain or loss is recognized? What is the character of the gain or loss recognized? What's the holding period? And what basis does the shareholder have in the distributed property it receives in liquidation of the company? Also, gain or loss realized. So gain or loss realized is simply going to be equal to the fair market value of the property and cash received minus the basis of the stock owned by the corporate shareholder. And that's because the shareholder is treated as having sold his stock in exchange for the property received. And this makes sense, right? Because now we're liquidating the corporation, so that stock basically gets canceled out, and the shareholder doesn't own stock or an equity interest in the corp anymore because the corporation doesn't exist anymore after liquidating. If the shareholder assumes any liabilities of the company, then the amount received is reduced but not below zero. The recognized gain or loss is equal to the realized gain or loss, and the character is usually capital, and it's usually long term, but it could be short term if he's held the stock in the corp for less than 1 year. But it is going to be capital in character because he holds stock, which is a capital asset to him. The holding period of the property begins the day after receipt, as we discussed about the table on page 5, and then the basis in the distributed property is the fair market value. Issues for distributing corporation. What is the realized and recognized gain or loss? What's the character? And what happens to the corporation's tax attributes upon liquidation? And what are tax attributes? Those are things like NOL carryovers, credit carryovers, charitable contribution carryovers. Those are all attributes. What happens to those attributes when the corporation liquidates? So, first of all, to calculate the gain or loss realized upon liquidating distribution of property, it's equal to the fair market value of the property minus the basis of the property to the corporation. The recognized gain or loss is equal to the same as the realized gain or loss. However, there are exceptions that apply that we'll discuss in a minute. And then the character follows the underlying nature of the distributed asset, which makes sense, right? The attributes go poof. So, oh, and another attribute, by the way, is EMP. So NOLs, credits, charitable contribution carryovers, and EMP attributes all go poof upon liquidation of the corporation. So this is an important planning technique. If you're going to liquidate the corporation, think about all of the attributes that exist before deciding to liquidate, because you may be losing some valuable tax attributes. Because remember, NOLs and credits can be carried over, and NOLs can be applied against future taxable income, reducing the tax liability, and credit carryovers can be applied against future tax liability to reduce the tax liability. If a shareholder assumes a corporation's liability, then the amount realized is reduced by the amount of the liability, and then the corporation recognizes gain for amount of debt in excess of distributed property's fair market value. So if it gets relieved of debt that is in excess of the property's fair market value, then it's going to recognize gain for that. And that's just your relief of debt rules. If you owe somebody some money and all of a sudden you don't have to pay them back, then really that cash that you got that was a loan from somebody really was just income to you. And that's why down the line, if you don't pay back the liability and instead somebody relieves you of the responsibility to pay back that liability, that amount, that debt has to now be claimed as income. That's from our example earlier. Gain or loss recognition for distributing corps. So you do have gain recognition on distribution of property, with the 4 following exceptions. If you have distributions to related parties, you recognize gain, but you don't recognize loss. And the loss cannot be recognized until that piece of property is sold outside of the related party group. If you have sales with a tax avoidance purpose, and that would just be a factual, look at that, or it could be subjective actually if you were audited by the IRS. Property with an adjusted basis in excess of fair market value that's contributed by the shareholder to the controlled corp, then in that case, the corporation must reduce the basis of the lost property. And then the 4th exception is where you're liquidating controlled subsidiaries, which is Section 332. Okay, so that's just exception 1 in detail. This is exception 2, which is tax avoidance purpose. So just look at these bullet points if you have to work through a problem or you have something on your test about tax avoidance purposes. Here's a little bit of a discussion about it. Exception 3 is where you're contributing built-in gain property into a controlled corp. And then exception 4 is your 332 exception, where you're liquidating a controlled subsidiary into its parent. Okay, the impact of the comments of the controlled subsidiaries liquidation on the shareholders. So if you have a Section 332 situation where you're liquidating a controlled subsidiary, which is CS, into your parent, then the parent does not recognize gain or loss, assuming that S, the subsidiary, is solvent, and any of the subsidiaries' NOLs move up to the parent. That's under Section 381. So yay, now the attributes don't go poof. They actually move up into the parent, because remember, we're economically the same if we just move our assets from one pocket to the other, right? As a person. And then no 332 non-recognition for P if it's insolvent. If S is insolvent, then 332 goes out the window, and it's actually a 331 liquidation, which is taxable to the parties. And so if S is insolvent, if its liabilities are in excess of the fair market value of its assets. So if its liabilities exceed its assets, it's considered to be insolvent. And then P is then able to recognize ordinary loss for the worthless stock or debt in S when it liquidates. But by the same token, S is going to have to recognize gain or loss. And that's under 331, that first bullet there that I was discussing earlier. Character of the gain is usually capital. Then the shareholder takes an adjusted basis equal to fair market value in the distributed property. So the parent takes basis of equal to fair market value in the distributed property of the subsidiary if it's a 331 transaction. And then the holding period starts new, it starts fresh. So if it's not covered under 332 because of insolvency of the subsidiary, then you have a 331 taxable event, and all of the bullets here apply. And the impact of the liquidation on the parent, assuming that 332 applies, then they have carryover basis in the distributed property. So in that case, the holding period and the basis carry over, and the methods used to determine book tax differences, by the way, those carry over to the parent too. Depreciation schedules don't change because basically P inherits all of the attributes, including bases of those depreciable assets, the holding periods. So basically, if a controlled subsidiary folds into parent, liquidates into parent under a 332 non-taxable event, though all of the fixed assets just continue to be depreciated, but now by the parent, and the depreciation will be claimed on the parent's return instead of the subs. And by the way, in this case, a lot of times the parent and the subsidiary in a controlled situation where there's 80% or more control by the parent of S, they're going to be filing a consolidated return anyway. Not always, but they can be. They can elect to do that. And if they're doing that, this 332 transaction is just simply a disclosure on the return. And then we talked about inheritance of S's tax attributes in the case of a 332. And if it is a 332, then because S is not insolvent, in other words, they're solvent, then S doesn't recognize any gain or loss on property distributed to P. Because again, no economic change. Okay, so definition of a complete liquidation, and it's funny because they're saving this until slide 28, but actually the definition of a complete liquidation is discussed on the first couple of pages of the chapter, so you can read about it there. And I think that's all I'm going to cover for right now, and then I will walk you through in a different video a couple of the problems so that you'll get a feel for how to treat a liquidating distribution. Talk to you soon. Bye.